Before we begin, it's crucial to understand the following. This video is for informational and educational purposes only. The content provided is not financial, investment, legal, or tax advice. I am not a licensed financial advisor. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. Past performance is not indicative of future results. All strategies and trades discussed are for illustrative purposes and should not be taken as direct recommendations. Please conduct your own research and consult with a qualified professional before making any financial decisions. Every single day, over $7.5 trillion changes hands in the global currency market. Let me say that again. $7.5 trillion. That is more than the entire New York Stock Exchange trades in a month, happening every 24 hours. It's the largest, most liquid financial market on the planet, and for decades, it was a playground exclusively for giant banks, hedge funds, and governments. But the internet changed everything. Suddenly, this massive river of capital became accessible to regular people. People like you. But let's be honest. When you hear the term Forex trading, what's the first thing that comes to mind? For many, it's those flashy ads on social media. Some guy on a yacht, laptop open, talking about financial freedom and a 3-step secret to overnight riches. Feels like a scam. Sounds too good to be true. And frankly, for the vast majority of people who jump in with no knowledge and a head full of hype, it becomes a painful lesson in how quickly you can lose money. This is not that kind of video. This is the video I wish I had when I first started. This is a 10-part masterclass specifically designed for beginners in the United States, updated for 2026, to cut through the noise, the hype, and the dangerous misinformation. Our goal here isn't to sell you a dream of getting rich quick. Our goal is to give you a real-world education. We are going to build your foundation from the ground up, brick by brick, so you can approach the Forex market with knowledge, a strategy, and a deep respect for risk. Over this series, you are going to learn what Forex actually is in plain English. No confusing jargon. You'll understand why the US dollar is the king of the currency world and how its movements affect everything. We will break down the specific rules and regulations that every American trader must know. Because trading in the USA is fundamentally different than anywhere else in the world. You'll learn how to read charts, not like a psychic, but like a technician looking for patterns and probabilities. We'll explore different trading strategies, helping you find a style that might fit your personality and your schedule. And most importantly, we will spend a huge amount of time on risk management, the single most critical skill that separates consistently break-even or potentially profitable traders from the 90% who burn out and quit. So let's start by destroying the number one myth about Forex trading right now. The myth is that it's a way to make fast, easy money. It is not. Forex trading is a high-performance skill. Think of it like learning to be a surgeon, a pilot, or a professional athlete. Would you expect to walk into an operating room on day one and perform a successful surgery? Of course not. You'd need years of study, practice, and mentorship. The market demands that same level of respect. The people who find long-term success are the ones who treat it like a serious business, a craft to be honed over time, not a lottery ticket. They are disciplined, patient, and they are obsessive about managing their risk. The money for them is a byproduct of executing a well-defined plan flawlessly over and over again. It is not the result of a lucky guess. So, if it's so difficult, why would anyone even bother? Why would you, sitting here in the United States, even consider trading Forex instead of stocks, options, or real estate? The answer lies in a few unique characteristics of this market. First, accessibility. The Forex market operates 24 hours a day, 5 days a week. It opens in Sydney on Sunday afternoon US time and closes in New York on Friday afternoon. This means that no matter your schedule, whether you have a 9 to 5, work a night shift, or are a busy parent, there is always a market session open for you to participate in. You're not chained to the 9:30 a.m. Eastern opening bell of the stock market. You can trade when it fits your life. Second is liquidity. Remember that $7.5 trillion number? That's called liquidity. It means there are so many buyers and sellers at any given moment for major currency pairs that you can typically enter and exit a trade almost instantly at a fair market price. In other markets, like with certain small cap stocks or obscure crypto coins, you might want to sell, but there's simply no one there to buy from you. That's a terrifying position to be in. In major Forex pairs, that's an extremely rare problem, which gives traders a level of flexibility that is hard to match. Third is leverage. Now, this is a double-edged sword, and we will have an entire video dedicated to using it responsibly, especially under US regulations, which are stricter for a reason. But leverage allows you to control a large position with a relatively small amount of capital. For example, with 50-to-1 leverage, which is the maximum allowed in the US for major pairs, you could theoretically control a $50,000 position with just $1,000 in your account. This magnifies potential profits, but, and I cannot stress this enough, it also magnifies potential losses just as quickly. Used incorrectly, leverage is the fastest way to wipe out your account. Used correctly, it is a powerful tool for capital efficiency. We will teach you the difference. So what exactly are we trading? When you trade Forex, you're not buying a piece of a company like a stock. You are simultaneously buying one country's currency while selling another's. You're speculating on the changing value of one currency relative to another. Think of it like this. You're planning a trip to Europe. You go to the bank and exchange $1,100 for 1,000 euros. The exchange rate is 1.10. While you're on vacation, some big economic news comes out that's very good for the US economy, and the dollar strengthens. When you come back, you have those same 1,000 euros, but now when you exchange them back, you only get $1,050 because the exchange rate has dropped to 1.05. You lost $50 simply because the relative value of the two currencies shifted. Forex traders do this electronically, thousands of times a day, without ever leaving home. They might speculate that the Japanese yen is going to weaken against the British pound and place a trade to profit from that potential move. They are trading an opinion, a hypothesis about the future direction of an exchange rate, based on economic data, chart patterns, and global events. In this first part, our goal is simply to set the stage. To replace the get-rich-quick hype with the foundation of reality. This is a journey of skill development. It will take time, it will take effort, and it will require discipline. But the path is learnable. You don't need a PhD in economics or a Wall Street background. You need a clear roadmap and a willingness to learn. Not just the how, but also the why. Throughout this series, we will be your guide on that roadmap. We'll cover everything from the absolute basics, like what a pip, or a lot, is, to the more complex topics of trading psychology and creating your own personalized trading plan. We will focus intently on the things that matter for American traders, from choosing a US-regulated broker to understanding the tax implications. This is your starting line. The fact that you're here, seeking out a structured education instead of a magic formula, means you're already on the right track. You've already separated yourself from the crowd that's destined to fail. So, what is the single most important decision you'll make before you ever place a trade? It's not what currency to buy. It's not when to sell. It's something that 9 out of 10 beginners get disastrously wrong, and it happens before they even deposit a single dollar into an account. This decision can be the difference between a long, sustainable trading career and blowing up your account in a week. And that is the exact topic we are breaking down in part 2. Choosing the right, US-regulated broker, and spotting the red flags you absolutely must avoid. So, how do you spot these red flags? How do you find a broker that's more like a fortress for your funds than a leaky boat in a hurricane? It starts with understanding why the United States is a completely different universe when it comes to Forex trading. Think of the global Forex market as the Wild West. In many parts of the world, it truly is. There are few rules, and the sheriff is often nowhere to be found. But after the 2008 financial crisis, the US government decided to build a town with walls, a sheriff, and a whole lot of deputies. This was called the Dodd-Frank Act, and it fundamentally changed the game for American traders. 2 names you absolutely must know are the CFTC, the Commodity Futures Trading Commission, and the NFA, the National Futures Association. These aren't just acronyms. They are your personal bodyguards in the market. The CFTC is the federal agency, the top-level law enforcement, that sets the rules. The NFA is the self-regulatory organization that enforces those rules on the ground. They are the ones who make sure brokers are financially sound, treat customers fairly, and aren't running some shady operation from a basement. Any broker that wants to legally offer Forex trading to US residents must be registered with the CFTC and be a member of the NFA. This is not optional. It's not a nice to have. It is the absolute, #1, non-negotiable requirement. If a broker is not regulated by these two bodies for a US trader, they might as well not exist. So, your first step, before you even look at their fancy website or their list of currency pairs, is to play detective. Go to the NFA's website. They have a tool called BASIC, which stands for Background Affiliation Status Information Center. You can type in the name of any broker, and it will tell you in black and white if they are registered and if they have any disciplinary actions against them. This 5-minute check can save you from months or even years of heartache. It's the financial equivalent of checking the locks on your doors at night. Once you've confirmed a broker is legitimate and regulated in the US, now we can start comparing them. Let's break down the key factors. First, the trading platform. This is your cockpit. It's where you'll analyze charts, make decisions, and execute trades. It needs to be reliable, fast, and intuitive. Many brokers offer popular third-party platforms like MetaTrader 4 or MetaTrader 5, known as MT4 and MT5. These are the industry standards, with tons of available tutorials and tools. Other brokers invest heavily in creating their own proprietary platforms, which can sometimes offer a cleaner interface or unique features. The name doesn't matter as much as the performance. Does it crash? Is there a delay when you place a trade? Most importantly, does it offer a demo account? A demo or paper trading account lets you trade with virtual money in a real market environment. This is your flight simulator. Never ever fly a real plane without spending hours in the simulator first. Use the demo account to test the platform's stability and see if you actually enjoy using it. Second, let's talk about the cost of doing business. Spreads and commissions. This is how brokers make their money. The spread is the tiny difference between the price you can buy a currency for and the price you can sell it for at any given moment. Imagine a currency exchange booth at the airport. They'll buy your dollars for one rate and sell you euros for a slightly worse rate. That difference is their profit. It's the spread. In Forex, these spreads are usually very small, measured in pips. Some brokers offer very tight or low spreads but charge a fixed commission on every trade you make. Others will say zero commission, but they build their fee into a wider spread. Don't get hypnotized by the words zero commission. It's not free. You have to look at the total cost. Which is better? A tight spread plus commission, or a wider spread with no commission? Honestly, for a beginner, the difference is often minimal. The key is transparency. A good broker clearly explains their fee structure. A shady one hides it in the fine print. Your job is to find the one that is upfront about how they get paid. Third, customer support. This is the one nobody thinks about until it's 3 a.m., the market is going wild, and your platform suddenly freezes. Who are you going to call? A reputable broker will have 24-hour support during the trading week, which runs from Sunday evening to Friday afternoon in the US. Before you deposit a single dollar, test their support. Use their live chat. Send them an email with a question. Call their phone number. Are they responsive? Are they helpful? Or do you get stuck in an automated menu for 20 minutes? Their response time before you're a customer is a strong indicator of how they'll treat you when you actually need them. Finally, look at account types and minimum deposits. As a beginner, you don't want to be forced to deposit $10,000. Look for brokers that offer micro or mini accounts. These allow you to trade with much smaller position sizes, meaning you can risk less money while you're learning. A broker that caters to beginners will have a low minimum deposit and flexible account types. It shows they understand the learning curve and aren't just hunting for massive accounts. Now let's flip the coin. We've talked about what to look for. Let's talk about the giant, flashing neon red flags that should have you running for the hills. The biggest red flag is the promise of unrealistic returns. If you see ads or get emails that talk about doubling your account in a month, or foolproof signals, close the tab. Run. Professional traders aim for consistent, realistic returns over a long period. They have winning months and losing months. Anyone promising a guaranteed path to riches isn't selling a trading service. They're selling a fantasy, and you're the one who will pay for it. The second, and this is huge for US traders, is the temptation of offshore brokers. You'll find them online, dangling an irresistible carrot. Massive leverage. US regulations cap leverage for retail traders at 50 to 1 on major currency pairs. These offshore brokers will offer 200 to 1, 500 to 1, even 1,000 to 1. It sounds amazing, right? Control a huge position with a tiny amount of money. But leverage is a weapon that cuts both ways. At 500 to 1 leverage, a tiny market move against you, less than a fraction of a percent, can wipe out your entire account in seconds. More importantly, these brokers are operating outside of US law. If they decide to freeze your account, refuse a withdrawal, or simply disappear with your money, you have virtually zero legal recourse. The CFTC and NFA can't help you. You're on your own. It's not worth the risk. Period. Another red flag is high-pressure sales tactics. A good broker is a financial services company. They should behave like your bank. They don't cold call you at dinner time, pressuring you to deposit more money. They don't assign you an account manager who gives you hot tips on what to buy or sell. That's a massive conflict of interest. Their job is to execute your trades, not tell you what trades to make. If it feels less like a financial institution and more like a boiler room, it's a scam. Finally, be wary of complexity and hidden fees. If you can't easily find information on their website about withdrawal fees, inactivity fees, or how they handle pricing, that's a problem. Reputable companies are proud of their transparency. Shady ones thrive on confusion. Choosing a broker isn't the most glamorous part of trading. It's not as exciting as finding the perfect trade setup, but it is the single most important decision you will make. It's the foundation upon which your entire trading career will be built. A solid, regulated broker gives you a fair chance to succeed. The wrong one can ensure you fail before you even begin. Okay, you've done your due diligence. You've checked the NFA database, you've compared platforms, and you've chosen a regulated broker that fits your needs. You've avoided the sharks. Now what? You open up the platform, and you're staring at a screen full of charts, numbers, and buttons that look like the cockpit of a 747. Can feel overwhelming. In the next part, we're going to demystify that screen. We'll walk you through setting up your trading platform, placing your very first practice trade, and understanding the core layout so you can navigate it with confidence. Alright, let's pull back the curtain on that screen full of flashing numbers and jagged lines. It looks like the control panel for a mission to Mars, I get it. But here's the secret. You only need to understand a few key controls to get off the ground. Think of it like a car's dashboard. You have 100 different lights and symbols, but to drive, you really just need the steering wheel, the pedals, and the speedometer. We're about to find your steering wheel. Our mission for the next few minutes is simple. To set up your trading platform and place your very first trade using a demo account. I want to repeat that, a demo account. This is play money. It's simulator time. You wouldn't try to land a 747 on your first flight lesson, and you won't risk a single real dollar on your first trade. This is all about building muscle memory and confidence, zero risk attached. First, the platform itself. In the world of Forex, you'll hear two names repeated over and over, MetaTrader 4 and MetaTrader 5, or MT4 and MT5 for short. They are the Toyota and Honda of trading platforms, reliable, widely used, and they get the job done. MT5 is the newer version with a few more bells and whistles, while MT4 is the tried-and-true classic that many traders still swear by. Many US brokers also offer their own proprietary platforms, which can be incredibly user-friendly and web-based. For today, the principles are universal. The buttons might be in a slightly different spot, but the functions are the same. When you sign up for a demo account with your chosen broker, they will provide a download link for their version of the platform. Use that one. Once you've installed the software and opened it up, you'll log in with the demo account credentials your broker gave you. The moment you do, that screen comes to life. Let's break it down into 4 key sections. First, on the left, you'll likely see the Market Watch window. This is your menu. It's a list of currency pairs like Euro to US dollar, Pound sterling to Japanese yen, and so on. Next to each pair, you'll see 2 prices, the bid and the ask. Don't overthink this. The bid is the price you can sell at, and the ask is the price you can buy at. The tiny difference between them is called the spread, and it's essentially how the broker makes a small commission on trades. All you need to know for now is that this window is where you choose what you want to trade. The biggest, most dominant part of your screen is the chart. This is your windshield. This is where you see the story of a currency pair's price over time. It's usually shown with what are called candlesticks. Each candle represents a period of time. Maybe 1 minute, 1 hour, or 1 day. If the candle is green, it means the price went up during that period. If it's red, the price went down. The main body of the candle shows where the price opened and closed, and the thin lines coming out of the top and bottom, called wicks, show the highest and lowest points the price reached. For now, just recognize that green means up, red means down. This chart is the visual battlefield where bulls and bears are fighting it out. The third window, often tucked away, is the navigator. Think of this as your file cabinet. It shows your different accounts, and a list of tools and indicators you can add to your chart later. We're not going to worry about this one today. We're keeping it simple. The fourth and final key section is the terminal, or toolbox at the bottom of the screen. This is your dashboard. It's where you'll see your account balance, your equity, and most importantly, any open trades you have. When you place a trade, it appears here. You can see if it's in profit or loss in real time. This window provides the feedback, tells you how you're doing. So, to recap, Market Watch is the menu, the chart is the windshield, and the terminal is the dashboard. That's it. You've just demystified 80% of what's on the screen. Now let's do it. Let's take our first test flight. Find the Euro to US dollar pair in the Market Watch window. Right-click on it and select New Order. A new window will pop up. This is the order ticket. This is where you tell the market exactly what you want to do. Let's walk through the critical fields. First, you'll see symbol. It should already say Euro to US dollar. Check. Next, and this is arguably the most important input, is volume or lot size. This determines the size of your trade. It's the throttle. You don't floor it on your first driving lesson. In Forex, a standard lot is 100,000 units of the base currency, which is a huge amount. But we're not trading standard lots. We're starting with the smallest possible size, a micro lot, which is 0.01. This means you're trading 1,000 units. By starting with the smallest size, you learn to manage your risk from day one. Always check this field. Set it to 0.01. Now for the safety features. You'll see fields for stop loss and take profit. These are your non-negotiable best friends in trading. A stop loss is an automatic order that closes your trade if the price moves against you by a certain amount that you define. It's your safety net. Protects you from large losses. Take profit is the opposite. It's an automatic order that closes your trade when it hits a specified profit target. Think of the stop loss as your emergency eject button, and the take profit as your mission accomplished button. You decide on these levels before you enter the trade, when you are calm and rational, not in the heat of the moment. For this first practice trade, let's just set a stop loss a little below the current price and a take profit a little above it. We're just learning the mechanics. Finally, you see the two big buttons, sell by market and buy by market. This is the decision. If you believe the price of the euro is going to go up against the US dollar, you click buy. If you think it's going to go down, you click sell. It's that simple. For this exercise, let's just click buy by market. Click it. You'll hear a little confirmation sound, and the order window will disappear. Now look down at your terminal window at the bottom. Boom! There it is. Your first trade is live. You'll see a line item with euro to US dollar, the size of the trade, the price you entered at, and a column for profit/loss. You'll see that number fluctuating in real time. It might be a few cents up, a few cents down. Welcome to trading. You've just participated in the largest financial market on the planet. Let it run for a minute. Watch how the price on the chart moves and how that affects the profit or loss number in your terminal. See the connection between the two. Now let's say you want to close the trade yourself. You don't have to wait for your stop loss or take profit to be hit. You are in control. You simply go to the trade in the terminal, right-click on it, and select Close Order. Confirm it and you're out. The trade is finished. It moves from the Trade tab to the Account History tab, leaving a permanent record. Take a breath. That's it. You did it. You've navigated the interface, you've understood the key components, you've set your risk parameters with a stop loss, and you've executed and closed your first practice trade. That intimidating screen isn't so scary anymore, is it? Just a tool. And now you know how to use it. You've moved from being a spectator to a participant. But this brings up the most important question of all. We just clicked buy as an example. But in the real world, why would we click buy? How do we form an opinion that the price is more likely to go up than down? You now know which buttons to press in the cockpit. But how do you know where to fly? That's where the map comes in. In the next part, we're going to introduce you to the two main schools of thought for analyzing the market. The two core ways traders decide when to buy and when to sell. It's the art and the science, and it's where the real journey begins. Imagine two detectives arriving at a scene. The first detective pulls out a magnifying glass and immediately starts analyzing the physical evidence. Footprints, trajectory patterns, the exact placement of every object. This detective believes the story of what happened is written right there in the immediate environment. The second detective, however, starts by interviewing witnesses, checking financial records, and looking into the motives and backgrounds of everyone involved. This detective believes the why is more important than the what. In the world of Forex trading, these two detectives represent the two great schools of thought: technical analysis and fundamental analysis. Understanding them isn't just an option. It's the foundation upon which every single trading decision you make will be built. Let's start with the first detective: technical analysis. At its core, technical analysis is the study of price movement. Technical analysts or chartists believe that all the information you need, from economic data to global market psychology, is already reflected in the price on your screen. They argue that history tends to repeat itself, and by studying past price patterns, they can forecast potential future movements. They aren't concerned with why a currency pair is moving. They are obsessed with how it's moving. Their entire world is the chart, and the most important tool in that world is the candlestick. While you might see simple line charts that just connect closing prices, most traders live and breathe by Japanese candlestick charts. Think of each candlestick as a miniature story of the battle between buyers and sellers over a specific period, whether that's 1 minute, 1 hour, or 1 day. A candlestick has a body and 2 wicks. The body tells you where the price opened and where it closed. If the body is green, it means the price closed higher than it opened, the buyers won that battle. If it's red, the price closed lower, the sellers won. The wicks, those thin lines sticking out of the top and bottom, show you the highest and lowest prices reached during that period. A long wick at the top suggests that buyers tried to push the price way up, but sellers fought back and pushed it down before the candle closed. It's a visual representation of a struggle, and learning to read these tiny stories is a crucial skill. Now, with these candlesticks, technical analysts build their case. They look for 3 primary clues. First, support and resistance. These are the most fundamental concepts in technical analysis. Imagine you're in a room. The floor beneath you is support, and the ceiling above you is resistance. In trading, a support level is a price point where a currency pair has historically had trouble falling below. It's an area where buyers tend to step in, seeing it as a bargain, and support the price. Resistance is the opposite. It's a price ceiling where sellers tend to take over, thinking the price is too high, and push it back down. These levels are powerful because they are self-fulfilling prophecies. Enough traders see a level on a chart and act on it, and that level becomes a real barrier. Identifying these floors and ceilings is like mapping out the battlefield. The second clue is the trend. As the old saying goes, the trend is your friend. Prices don't move in a straight line. They move in waves, creating trends. An uptrend is a series of higher highs and higher lows. Think of it like walking up a staircase. You take a step up, then a small step back onto a higher stair, then another step up. A downtrend is the opposite. A series of lower highs and lower lows, like walking down that same staircase. And sometimes the market moves sideways in a range, bouncing between a clear support and resistance level. The first job of a technical analyst is to identify the current trend, because trying to trade against a strong trend is like trying to swim against a powerful current. It's possible, but it's exhausting and incredibly difficult. The third clue comes from using specialized tools called indicators. If charts are the crime scene, indicators are the forensic kit. These are mathematical calculations based on price and volume, plotted on the chart to help traders make decisions. You might have heard of some, like moving averages, which smooth out price data to help you see the underlying trend more clearly. Or the relative strength index, the RSI, which can help suggest if a currency is overbought or oversold. There are hundreds of these indicators, and it's easy to get lost. A common beginner mistake is to plaster a dozen different indicators on a chart, making it an unreadable mess. The reality is, most professional traders use only a few, and they understand them deeply. We'll explore the most important ones in a later part of this series, but for now, just know they exist to help confirm what you're already seeing in the price action. So that's our first detective, the technical analyst. They look at the chart, identify support and resistance, determine the trend, and use indicators to time their entries and exits. It's a discipline based on patterns, probability, and market psychology reflected in price. But what about the why? What's actually causing these trends and breaking these levels? For that, we need to bring in our second detective, the fundamental analyst. Fundamental analysis is the study of the economic, social, and political forces that drive supply and demand for a currency. If a country's economy is strong and growing, its currency is likely to be in high demand, causing its value to rise. A fundamental analyst is an economic detective, looking at the big picture to determine a currency's true, intrinsic value. They believe that in the long run, a currency's price will reflect the health of its underlying economy. Their clues aren't on a chart. They're in the news and in economic data reports. There are a few key pieces of evidence they always look for. The heavyweight champion of fundamental factors is interest rates. Central banks, like the Federal Reserve in the US, set their nation's core interest rate. Think of it this way: if you could put your money in a savings account in country A and get a 1% return, or in country B and get a 5% return, where would you put your money? Country B, of course. Global capital works the same way. Money flows toward currencies with higher interest rates to chase that higher return, or yield. This increased demand strengthens the currency. That's why every time the Federal Reserve even hints at raising or lowering interest rates, the US dollar can move dramatically. Next up is the country's economic report card. Gross domestic product, or GDP. This is the total value of all goods and services produced by a country. A steadily growing GDP indicates a healthy, expanding economy, which is attractive to foreign investors and generally supportive of a stronger currency. Then there's inflation, measured by things like the Consumer Price Index, or CPI. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. A little bit of inflation is considered healthy for an economy, but high uncontrolled inflation is a currency killer. It erodes the value of money, making it less attractive to hold. Central banks often raise interest rates to fight inflation, which brings us right back to the most important factor. And for the US dollar specifically, one of the most watched reports is the Non-Farm Payrolls, or NFP. Released on the first Friday of every month, it shows how many jobs were created or lost in the US. It's a powerful snapshot of the health of the American economy. More jobs means more people earning and spending money, which fuels economic growth and can strengthen the dollar. The NFP release day is famously one of the most volatile trading days of the month. So the fundamental analyst is constantly monitoring these reports, listening to speeches from central bank governors, and tracking geopolitical events to build a picture of a nation's economic health. Now for the million-dollar question. Which one is better, technical or fundamental? This debate is as old as the markets themselves. Hardcore technical traders will tell you that fundamentals are just noise because it's all in the price anyway. Die-hard fundamentalists will say that charts are just squiggly lines that tell you nothing about a currency's real value. The truth, as it often is, lies somewhere in the middle. Most experienced traders find value in both. They use fundamental analysis to form a long-term bias. For example, if the US economy is strong and the Federal Reserve is raising interest rates, they might form a bullish bias on the US dollar. They believe fundamentally that the dollar is likely to go up. But when do they buy? They don't just click the buy button after reading a news report. That's where they put on their technical analyst hat. They'll pull up the charts and look for a specific entry point. Maybe they'll wait for the price to pull back to a key support level, or for an uptrend to clearly establish itself. Think of it like this. Fundamental analysis tells you which direction to drive the car. Technical analysis tells you the exact moment to press the gas pedal. One gives you the why, the other gives you the when. Combining them gives you a comprehensive framework for making trading decisions, grounding your chart-based setups in real-world economic context. So now you know the two main philosophies, but knowing the why and the when is useless if you don't have a place to actually make the trade. In the next part, we're going to demystify the most critical tool in your arsenal, the trading platform. We'll show you how to choose the right one for a US trader, what all those confusing buttons mean, and how to place your very first practice trade without risking a single dollar. This is your cockpit. Imagine sitting in the pilot's seat of a high-performance jet. Before you is a dazzling array of screens, buttons, and flashing lights. It's intimidating, but it's also the source of all your power and control. That, in essence, is your trading platform. It's the digital bridge connecting you to the largest financial market in the world. And just like a pilot, you need to know what every single one of those controls does before you even think about taking off. First, let's address the elephant in the room for every aspiring trader in the United States. Why do your options for brokers and platforms seem so much more limited than what you see traders in other countries using? The answer is one word: regulation. After the financial crisis of 2008, the US government, through agencies like the Commodity Futures Trading Commission, or CFTC, and the National Futures Association, or NFA, put a regulatory fortress around Forex trading to protect consumers. This means brokers who want to operate in the US have to meet incredibly high standards for capital, transparency, and fairness. While this limits your choices, it's a massive benefit. It weeds out many of the less reputable players, giving you a safer environment to start in. So when you choose a US-regulated broker, you're choosing a broker that is held to one of the highest standards on the planet. With that understood, your platform choice generally falls into three main categories. First, you have proprietary platforms. These are the custom-built platforms designed and offered by the brokers themselves. Think of the platforms from major players like Forex.com or OANDA. The big advantage here is seamless integration. Everything from funding your account to executing a trade is all in one clean, often very user-friendly package. They are typically designed with beginners in mind, featuring intuitive layouts and built-in educational resources. The potential downside? You're locked into that broker's ecosystem. If you ever want to switch brokers, you'll have to learn an entirely new platform from scratch. The second, and arguably the most famous category, is MetaTrader. You'll see it as MT4 or its newer sibling MT5. Think of MetaTrader as the Android or Windows of the trading world. It's not made by a specific broker. Instead, it's a third-party software that hundreds of brokers across the globe license and offer to their clients. Its popularity is its greatest strength. The community is enormous. This means there's a universe of custom indicators, tutorials, and automated trading programs called expert advisors, or EAs, built for the platform. Learning MT4 or MT5 is like learning to drive a car with a standard manual transmission. Once you know it, you can pretty much drive any car. It's a skill that travels with you if you ever decide to switch brokers. The third category is a bit of a hybrid, but it's essential to know TradingView. Initially, TradingView was purely a charting and analysis platform, and it is arguably the best in the world at that. Its charts are beautiful, intuitive, and incredibly powerful. It also has a massive social component, where traders share ideas, analyses, and custom scripts. It's like the social network for market technicians. Today, many US-regulated brokers have integrated their services directly with TradingView, allowing you to place trades from its charts. For many, the ideal setup is using TradingView for all their analysis, and then either executing there or on their broker's primary platform. So how do you choose? Don't focus on what the pros are using. Focus on you. Ask yourself, is this interface intuitive to me? Can I easily find what I'm looking for? A clunky, confusing platform can lead to costly mistakes. Does it have robust charting tools that are easy to use? You'll be spending 99% of your time looking at charts. How is the mobile app? If you plan on checking your trades on the go, a good mobile experience is non-negotiable. For now, in 2026, the best advice is to open demo accounts with a couple of different types. Try a top-tier proprietary platform and try a broker that offers MetaTrader. Spend a week with each. See which one clicks with your brain. The one that feels less like a chore and more like a tool is the one for you. Okay, let's pull one of these platforms up on the screen and dissect it. Don't be overwhelmed. It all boils down to four key areas. First, you have the Market Watch window. This is usually a list on the left side of your screen. It shows you all the available currency pairs like Euro to US dollar, Pound sterling to Japanese yen, and so on. Next to each pair, you'll see two prices, the bid and the ask. The bid is the price at which you can sell the currency. The ask is the price at which you can buy it. The tiny difference between these two prices is called the spread. That spread is one of the main ways the broker makes money. It's their fee for facilitating the trade. The second and most important area is the chart window. This is the big main section of your screen, your window into the market's soul. It's where you'll see the dance of the candlesticks, representing price movement over time. Along the bottom is the time axis, and on the right is the price axis. You can change the time frame of this chart, looking at price movements minute by minute, hour by hour, or even day by day. This is where you will conduct all your analysis, drawing trend lines, adding indicators, and trying to decipher the market story. Third is the navigator window. This is your command center for tools. It's where you'll find your different trading accounts, like switching between your demo and a future live account, a list of all the technical indicators you can add to your charts, and any expert advisors you might use later on. You won't live in this window, but it's where you go to grab your tools. And finally, the fourth key area is the terminal or toolbox window, usually at the bottom. This is your dashboard for everything that's happening right now. It has several tabs, but the most important one is the Trade tab. This is where you'll see your account balance, your equity, your margin, and most importantly, any trades you currently have open. It will show you in real time whether your trade is in profit or loss. Watching these numbers fluctuate is your first lesson in managing trading psychology. Now for the moment of truth. Let's place our first trade on a demo account. Remember, this is practice. It's simulator time. We're using play money, so there is zero financial risk. Let's say, after looking at the chart for the euro versus the US dollar, you believe the euro is going to increase in value. You want to buy. You'll look for a new order button. Clicking it brings up an order ticket. This little box is where you give your instructions. First, you confirm the symbol is euro to US dollar. Next, and this is critically important, is the volume or lot size. This determines how much money you're exposing to the market. This concept is so vital we're dedicating an entire future part to it. For now, on your demo account, always select the absolute smallest volume possible, usually 0.01 lots. Next, you'll see two of the most important fields on the entire platform: stop loss and take profit. A stop loss is your safety net. It's an order you set at a specific price below your entry point that automatically closes your trade if the market moves against you. It defines the maximum amount you are willing to lose on this single trade. It is your non-negotiable risk management tool. Take profit is the opposite. It's a preset price target where your trade will automatically close in profit. Once you've set your volume, your stop loss, and your take profit, you face the final choice: sell by market or buy by market. Since our analysis suggested the euro would go up, we click buy. And just like that, you've done it. Down in your terminal window, you'll see a new line item appear. Your first trade is live. You'll see it fluctuating, maybe a few cents in profit, maybe a few cents in loss. Take a moment and just watch it. Feel that little jolt of excitement or anxiety. That emotion is completely normal. And it's exactly why we start here, in the safety of a demo account, to learn how to manage those feelings while mastering the controls of our cockpit. Because clicking the buy or sell button is the easiest part of trading. The real skill, the art and science we're going to explore next, is knowing why and when to click it. That begins with learning to read the story that the charts are telling you. And every chart, no matter how chaotic it looks at first, is telling a story. It's a second-by-second, minute-by-minute account of a global tug-of-war between buyers and sellers. Technical analysis is simply the skill of learning to read that story. It's not about a crystal ball or predicting the future with absolute certainty. Think of it more like being a weather forecaster. A meteorologist looks at atmospheric pressure, wind patterns, and historical data to forecast the probability of rain. They don't know for sure if it will rain at 3:05 p.m., but they can identify the conditions that make rain highly likely. As a trader, you are a market meteorologist. Your charts are your satellite images and weather models. You're looking for patterns and conditions that have historically led to specific outcomes, increasing the probability of a successful trade. This all starts with the chart itself, and you'll encounter three main types. The first is the line chart. It's the simplest of all. You've seen it 1,000 times on the news. It just connects the closing price of a currency pair from one period to the next, creating a single continuous line. It's great for getting a quick, clean overview of the long-term trend, but it leaves out a ton of crucial information about what happened within those periods. That's why most traders quickly move on to bar charts. A bar chart gives you 4 key pieces of information for each time period, which is why they're often called OHLC charts. The open, the high, the low, and the close. Each period is represented by a vertical line. The very top of the line shows the highest price reached during that period, and the bottom shows the lowest price. A small horizontal tick on the left side of the bar shows the opening price, and a similar tick on the right side shows the closing price. Suddenly, you have much more context. You can see not just where the price ended, but the entire price range and volatility of that session. But the chart that has become the gold standard, the one you'll see on nearly every professional trading platform, is the Japanese candlestick chart. It shows the exact same 4 pieces of data as a bar chart, the open, high, low, and close, but it presents them in a way that is far more visual and intuitive. Each candle has 2 parts, the body and the wicks. The body is the thick, rectangular part, which represents the range between the opening and closing price. The wicks, also called shadows, are the thin lines extending above and below the body. They show the highest and lowest prices reached during that period. Here's the magic. The color of the candle's body tells you the direction of the price movement at a glance. Traditionally, if the price closed higher than it opened, the candle is green or white, representing a bullish or upwardly moving period. If the price closed lower than it opened, the candle is red or black, representing a bearish or downwardly moving period. Instantly, you can see the narrative of the market. A long green body tells you that buyers were in strong control and pushed the price up significantly. A long red body tells you sellers dominated. A candle with a tiny body but very long wicks on either side suggests a period of intense struggle and indecision between buyers and sellers, with neither side winning. These visual cues, these individual candle shapes and patterns, form the very alphabet of technical analysis. Now, each one of these candles represents a specific slice of time, and this is another critical concept: time frames. You can set your chart to show you a candle for every 1 minute, 5 minutes, 1 hour, 4 hours, 1 day, or even 1 week. The story of the euro versus the US dollar on a 1-minute chart can look completely different from its story on a daily chart. The 1-minute chart might show a frantic, choppy market, while the daily chart shows a slow, steady uptrend. Which one is right? They both are. They're just telling different parts of the same story. A day trader who aims to be in and out of trades within minutes or hours might live on the 5-minute and 15-minute charts. A swing trader who holds positions for days or weeks will likely focus on the 4-hour and daily charts to make their decisions. The time frame you choose must align with your trading strategy and how long you intend to hold your positions. There is no best time frame, only the one that is best for you. Once you've chosen your chart type and time frame, the first and most fundamental skill you must develop is identifying support and resistance. These are the two most important concepts in all of technical analysis. Imagine price moving in a multi-story building. Support is the floor. It's a price level where a downtrend tends to pause or reverse because buying interest demand is strong enough to overcome the selling pressure. Think of it as a price point where buyers see value and start stepping in, creating a floor that supports the price. Resistance is the ceiling. It's a price level where an uptrend tends to stall or reverse because selling interest supply overwhelms the buying pressure. This is a price point where sellers believe the currency is overvalued and they begin to sell, creating a ceiling that resists further price increases. To find these levels, you simply look at your chart and identify historical price points where the market has repeatedly reversed. If you see a price that the market has dropped to and bounced off of 3 or 4 times in the past, you've likely found a significant support level. If you see a price it has risen to and been rejected from multiple times, you've found a resistance level. These levels represent the market's memory. They are key psychological battlegrounds between buyers and sellers. And here's a powerful insight. When a floor breaks, it often becomes the new ceiling. And when a ceiling breaks, it often becomes the new floor. This is called the role reversal principle. Let's say the price has been struggling to break above a resistance level at 1.2500. After several attempts, it finally smashes through. That old resistance level of 1.2500 is now very likely to act as a new support level. Traders who missed the initial breakout will often wait for the price to pull back to this level to enter a buy trade, reinforcing it as a new floor. Understanding this dynamic is a cornerstone of many trading strategies. These support and resistance levels define the market structure and help us identify the overall trend. A market can be in one of 3 states. An uptrend is defined by a series of higher highs and higher lows. Think of it like walking up a staircase. Each step up is a new high and each flat part of the step is a higher low. As long as this structure is intact, the buyers are in control. A downtrend is the opposite, a series of lower highs and lower lows. It's like walking down a staircase. The sellers are in control. The third state is a sideways or ranging market. This is when the price is bouncing back and forth between a well-defined support level and a well-defined resistance level, like a tennis ball being hit back and forth across a court. There's no clear trend. Buyers and sellers are in a state of equilibrium. Recognizing which of these 3 environments you're in is absolutely crucial, because different strategies work in different environments. A trend-following strategy will perform well in an uptrend or downtrend, but will likely get chopped up and result in losses in a ranging market. Conversely, a strategy designed to buy at support and sell at resistance can be effective in a range, but could lead to major losses if applied in a strong trending market. So let's put it all together. You open your chart. You're looking at the euro to US dollar on a 4-hour candlestick chart. You zoom out and notice that for the past month, the price has been making higher highs and higher lows. You've just identified an uptrend. You draw a line connecting the lows, your trend line. Then you notice a specific price, say 1.0950, where the price has pulled back and bounced up from twice before. You've identified a key support level that also happens to align with your uptrend. You're no longer staring at a meaningless series of red and green bars. You're reading the narrative. Buyers are in control, the trend is up, and there's a historical floor where other buyers have shown interest. This is the foundation of forming a trading plan, a logical, evidence-based reason for considering a trade. Learning to see the market this way, as a structured environment of trends, floors, and ceilings, is the first giant leap from gambling to trading. But these are just the basic building blocks. What if we could add tools to our chart that help us confirm these trends, measure their momentum, and spot potential reversals with greater clarity? What if we had a sort of market GPS to help us navigate these price movements? That's where technical indicators come in, and that's exactly what we're breaking down next. Technical indicators are not a crystal ball. Let's get that out of the way right now. They don't predict the future with 100% certainty. What they are, however, are incredibly powerful tools. Think of them as specialized lenses or diagnostic scanners for your price charts. They take raw price and volume data and run it through mathematical formulas to give you a clearer, more organized view of what the market might be doing. They help you quantify market sentiment, measure momentum, and identify conditions that have historically led to certain outcomes. They are your market GPS, helping you see the underlying structure in what can often look like pure chaos. But before we dive into the most popular ones, you need to understand the single most important concept about indicators. There are generally two types: lagging indicators and leading indicators. Lagging indicators, like moving averages, follow the price action. They confirm a trend after it has already started. They're slower, but they often provide more reliable, confirmed signals. Think of them as looking in the rearview mirror to confirm the road you've just traveled on is, in fact, a straight highway. Leading indicators, like many oscillators, try to anticipate future price movements. They can signal a reversal before it happens. They offer the advantage of getting in early, but they also give more false signals. It's like a GPS warning you of a potential traffic jam up ahead. It might be right, or the traffic might clear up by the time you get there. A successful approach often involves using a combination of both to get a more complete picture. So let's build your toolkit, starting with the absolute foundation: trend indicators. The most famous of all is the moving average, or MA. A moving average does exactly what its name says. It calculates the average price of a currency pair over a specific number of periods, say the last 20 candles, and plots it as a smooth line on your chart. This act of smoothing filters out the day-to-day noise and reveals the underlying long-term direction of the trend. The two most common types are the simple moving average, the SMA, which gives equal weight to all prices in the period, and the exponential moving average, the EMA, which gives more weight to the most recent prices, making it react faster to new information. So how do traders use them? One of the most classic techniques is the moving average crossover. For example, many traders watch the 50-period and the 200-period moving averages on a daily chart. When the shorter-term 50 MA crosses above the longer-term 200 MA, it's known as a golden cross, a signal that analysts often interpret as a potential start to a long-term uptrend. Conversely, when the 50 MA crosses below the 200 MA, it's called a death cross, which some see as a signal of a potential long-term downtrend. Moving averages also act as dynamic levels of support and resistance. In a strong uptrend, you'll often see the price pull back to a moving average, bounce off it, and then continue its upward journey. It's a visual guide to the market's backbone. Next up, we have our momentum indicators, also known as oscillators. While moving averages tell you the direction of the trend, oscillators tell you how strong and how fast that trend is moving. They help you answer the question: is this trend running out of steam? The undisputed king of oscillators is the Relative Strength Index, or RSI. The RSI is displayed as a line graph that moves between 0 and 100. Think of it like a car's tachometer. It measures the speed and change of price movements. The RSI has two critical levels that traders watch: 70 and 30. When the RSI moves above 70, the instrument is considered to be overbought. This doesn't mean you should immediately sell. A strong trend can stay overbought for a very long time. It's more like a warning light on your dashboard. The engine is running hot, and you should pay close attention. When the RSI drops below 30, it's considered oversold. Again, this isn't an automatic buy signal, but an alert that selling pressure may be getting exhausted. One of the most studied applications of the RSI is looking for divergence. Let's say the price of a currency pair makes a new higher high, but the RSI makes a lower high. This is called bearish divergence. It suggests that even though the price is pushing up, the momentum behind the move is fading. It's like a climber taking smaller and smaller steps as they near the summit, a potential sign that they're about to turn around. Now let's talk about volatility indicators. These don't care about the direction of the trend. They only care about how much the price is moving. The most popular tool for this is Bollinger Bands. Imagine a river. Bollinger Bands consist of 3 lines. A moving average in the middle, which is the river's main current, and 2 bands on either side, which are the riverbanks. These outer bands are based on standard deviation, a statistical measure of volatility. When the market is quiet and calm, the bands contract and get closer together. The river is narrow. This is known as a squeeze. Analysts have observed that these periods of low volatility are often followed by periods of high volatility, a breakout. When the market is volatile, the bands expand and move further apart. The river is wide and raging. Traders use the bands to gauge relative highs and lows. A price touching the upper band isn't necessarily a sell signal, but it does tell you that the price is high relative to its recent average. It provides crucial context about the market's current state of excitement or boredom. Finally, let's look at a powerful hybrid indicator that combines trend and momentum, the MACD, which stands for Moving Average Convergence Divergence. The MACD might look complicated, but it's really just about the relationship between 2 different exponential moving averages. It has 3 components: the MACD line, a signal line, and a histogram. The most common signals analysts look for are crossovers. When the MACD line crosses above the signal line, it's often viewed as a bullish signal. When it crosses below, it's seen as a bearish signal. The histogram is a simple visual aid. It represents the distance between the MACD line and the signal line. When the histogram is above 0 and growing, it suggests bullish momentum is increasing. When it's below 0 and falling, it suggests bearish momentum is building. Just like the RSI, the MACD is also excellent for spotting divergence, providing those subtle clues that a trend's underlying strength might be shifting. Now, with all these incredible tools, let me tell you about the single biggest mistake almost every new trader makes. They turn their chart into a Jackson Pollock painting. They add 10 different indicators, 3 moving averages, RSI, MACD, Bollinger Bands, something called a stochastic oscillator, and a dozen other lines until the price is barely visible. This is called analysis paralysis. Because most indicators are derived from the same price data, you end up with a dozen tools telling you slightly different versions of the same thing, often with conflicting signals. You get a buy signal from one and a sell signal from another, and you freeze, unable to make a decision. The secret is not to find the one magic indicator. It doesn't exist. The goal is to choose 2 or 3 indicators that give you different types of information, one for trend, one for momentum, maybe one for volatility, and learn them inside and out. Your strategy should be based on price action first, the support, the resistance, the candlestick patterns we discussed. The indicators are there to confirm what you think you see in the price. This concept is called confluence. You're looking for multiple, non-correlated signals to all point in the same direction. For instance, you might identify a key support level. You see the price come down to that level and form a bullish hammer candle. At the same time, you notice your RSI is coming out of the oversold territory. Now you have 3 different reasons to consider a long trade: a historical price level, a bullish candlestick pattern, and a momentum indicator suggesting selling is exhausted. This is a much higher probability setup than just blindly buying because an indicator hit a certain number. Remember, these indicators are your supporting cast. The price chart is the star of the show. They add depth, context, and a layer of objective data to your analysis. But they are servants to the price, not masters of it. Mastering a few key indicators and understanding how they complement your analysis of the raw price action is a giant leap forward in your trading journey. But now this raises the most important question of all. You have your charts. You have your patterns. You have your indicators. How do you combine all of this into a repeatable, testable set of rules? How do you create a concrete plan that tells you exactly when to enter, where to place your stop loss, and when to take profits? And most critically, how do you manage your money so that a string of losses doesn't destroy your account? Because without that, nothing else matters. That's the science of risk management and building a trading plan, and it's the professional framework we're constructing in the very next part. This framework isn't about finding some secret indicator or a can't-lose strategy. It's the boring, professional, and absolutely essential architecture that separates the 5% of traders who find consistency from the 95% who donate their capital to the market. This is your business plan. And every successful business starts with a plan. First, let's be clear about what a trading plan is. It is a written document that defines every single aspect of your trading. It's your personal rulebook, your constitution. Its primary purpose is to take your greatest enemy out of the equation. You. Or more specifically, the emotional, impulsive, in-the-moment version of you. When real money is on the line and the charts are flying, fear and greed take over. Fear makes you close winning trades too early. Greed makes you hold losing trades too long, hoping they'll turn around. A trading plan, created when you are calm and rational, is your shield against these emotions. It's the pilot's pre-flight checklist. You don't just wing it at 30,000 feet, and you don't wing it in the largest financial market in the world. So, what goes into this critical document? Let's build one piece by piece. Number 1. Your trading goals. And make a lot of money is not a goal. It's a wish. A professional goal is specific, measurable, and realistic. For example, my goal is to achieve an average monthly return of 3% while keeping my maximum drawdown below 10%. This immediately sets a logical benchmark. It tells you what you're aiming for and what level of risk is acceptable to get there. It grounds you in reality. Number 2. Your trading style and markets. Are you a day trader, looking to be in and out of trades within the same day? Or a swing trader, holding positions for several days or weeks? You must define this. Trying to be both at once is a recipe for confusion. Then, which currency pairs will you trade? A beginner trying to watch 20 different pairs is like a new chef trying to cook 20 different meals at once. It's chaos. Pick 2 or 3 major pairs like the euro to US dollar or the US dollar to Japanese yen. Learn their personalities. Understand how they move. Master a few before you even think about expanding. Number 3. Your entry and exit rules. This is the core of your strategy, and it must be written with zero ambiguity. Your entry criteria are the specific set of conditions that must be met before you can click the buy or sell button. For instance, a rule could be, I will only enter a long trade on the 4-hour chart if the price is above the 200-period moving average and the relative strength index has crossed above 50. If only one of those conditions is met, you do nothing. You wait. This discipline is what trading is all about. Just as important are your exit rules. Every single trade you enter must have a predefined exit plan for both a loss and a profit. Your exit for a loss is your stop-loss order. This is the price at which you accept you were wrong, the trade is invalidated, and you exit automatically to protect your capital. It is non-negotiable. Your exit for a profit is your take-profit target. This is where you plan to cash in, letting a profitable trade run only to watch it reverse and turn into a loss because of greed is one of the most painful lessons in trading. Define your exit and honor it. This brings us to the engine room of your entire trading career. Risk management. You can have the best strategy in the world, but without professional risk management, you will fail. It's a mathematical certainty. The foundation of this is the single most important rule in trading, the 1% rule. This rule is simple. You should never risk more than 1% of your total trading capital on any single trade. If you have a $5,000 account, your maximum acceptable loss on one trade is $50. That's it. To a beginner, this sounds impossibly small, almost boring. You're here to make money, not pennies, right? Wrong. This rule isn't about making money. It's about staying in the game. Let's run the numbers. If you risk 20% of your account on each trade, it only takes 5 consecutive losses to wipe you out completely. 5. And trust me, 5 losses in a row will happen to every single trader, no matter how good they are. But if you risk just 1% per trade, you would need to lose 100 trades in a row to wipe out your account. The psychological difference is monumental. The 1% rule allows you to withstand the inevitable losing streaks that are a natural part of trading. It keeps you solvent long enough to let your strategy's edge play out over time. This rule directly dictates your position size, how many lots you trade. It's not a guess. It's a precise calculation. The formula looks like this. You take your account size, multiply it by your risk percentage, 0.01 for 1%, and then divide that by your stop-loss distance in pips. Let's say you have that $5,000 account, and you want to risk 1%, which is $50. Your analysis tells you that your stop-loss needs to be 50 pips away from your entry price. You divide your $50 of risk by those 50 pips. That equals $1 per pip. You then select a position size, in this case a mini lot, where each pip movement is worth $1. You have now mathematically engineered the trade, so that it is impossible for you to lose more than your predefined $50 risk. This is how professionals engage with the market. The next layer of risk management is your risk-to-reward ratio. This is the ratio of what you stand to gain versus what you stand to lose. If your stop loss is 50 pips away and your take profit target is 100 pips away, you have a 1-to-2 risk-to-reward ratio. This is a game changer. Why? Because it means you don't have to be right all the time to be profitable. Think about that. If you only take trades with a 1-to-2 risk-to-reward ratio, you could be wrong on 2 trades, losing $50 each for a total loss of $100. Then you could be right on just 1 trade, making $100. Over those 3 trades you've broken even, yet your win rate was only 33%. With a positive risk-to-reward ratio, your winners pay for your losers and then some. This frees you from the psychological pressure of needing to win every trade. Your job isn't to be a perfect predictor. It's to be a great manager of probabilities and risk. Finally, the tool that ties all of this together, the trading journal. Your trading plan is your rulebook before the trade. Your journal is your performance review after the trade. For every single trade, win or lose, you log the details. The currency pair, your entry and exit prices, the reason you took the trade, the risk-to-reward ratio, and the final outcome. Most importantly, you log your emotional state. Were you feeling anxious? Overconfident? Did you follow your plan to the letter? Or did you deviate? This might seem tedious, but it is the ultimate tool for growth. After 50 or 100 trades, your journal will reveal your patterns, your strengths, and your weaknesses with brutal honesty. You might discover that you lose money every time you trade on a Friday afternoon, or that your strategy works incredibly well on the pound sterling to US dollar but fails on the Australian dollar to US dollar. This isn't guesswork. It's your personal data. The journal transforms trading from a series of emotional gambles into a data-driven business where you are constantly refining your edge and improving your performance. You now have the business plan. You have the risk controls of a professional fund manager. All that's left is to step into the cockpit. In the next part, we're firing up the engines. Choosing the right US-regulated broker, setting up your trading platform, and placing your very first trade in a risk-free environment. Okay, let's talk about the single most important decision you'll make at this stage. Choosing your co-pilot, your ground crew, and your aircraft all in one. This is your broker. In the United States, this choice is not just about low fees or a flashy website. It's about safety, security, and playing by the rules. The world of Forex can feel like the Wild West, but the US has sheriffs, and their names are the CFTC and the NFA. The Commodity Futures Trading Commission, or CFTC, is the federal agency that regulates the derivatives markets, which includes Forex. The National Futures Association, or NFA, is the self-regulatory organization for the industry. Think of the CFTC as the government setting the laws of the sky, and the NFA as the air traffic control tower that enforces them. Any broker that wants to legally operate in the United States and accept U.S. clients must be registered with both. This is non-negotiable. It's your number one line of defense. Why is this so critical? A regulated broker is required to hold your funds in segregated accounts, separate from their own operational capital. This means if the broker goes under, your money doesn't go down with the ship. They also must adhere to strict financial standards and fair dealing practices. Going with an unregulated, offshore broker to get around U.S. rules is like choosing to fly a plane that hasn't passed a single safety inspection. You might get access to insane leverage or questionable bonuses, but you're flying blind with no parachute. So your first step is to go to the NFA's website. They have a search tool called BASIC. That's BASIC. You can type in the name of any broker, and it will tell you if they are a registered NFA member in good standing. If they're not on that list, you close the browser tab and you walk away. Period. Now, once you have a short list of NFA-regulated brokers, how do you choose? There are 4 key components to the aircraft you're about to board. First, the trading platform. This is your cockpit. It's where you'll analyze charts, make decisions, and execute trades. The industry standard for decades has been MetaTrader 4, or MT4, and its successor MT5. Think of MT4 as the reliable, universally understood cockpit of a Boeing 737. Almost every pilot knows how to fly it, and there's a massive community that builds custom instruments and tools for it, known as indicators and expert advisors. Many brokers offer this. Some, however, have invested heavily in creating their own proprietary platforms. These can be like the sleek, modern glass cockpit of a brand new Airbus A350, beautiful, intuitive, with unique features. The downside is, if you learn on a proprietary platform and later want to switch brokers, you have to learn a whole new system. For a beginner, starting with MT4 or MT5 is often a solid choice due to the wealth of educational resources available for it. Second, spreads and commissions. This is the price of fuel for your journey. This is how brokers make money. The spread is the tiny difference between the buy price and the sell price of a currency pair. Imagine a currency exchange booth at the airport. They might buy your dollars for 1.10 euros but sell you euros for 1.12. That 2-cent difference is their spread. In Forex, this is measured in pips. A lower spread means a lower transaction cost for you. Some brokers offer very tight spreads but charge a flat commission per trade. Others charge no commission and just have a slightly wider spread. There's no universally better option. It depends on your trading style. But for now, just look for brokers that are transparent and competitive with their pricing. Third, account types and minimum deposits. U.S. regulations limit leverage for retail traders to 50-1 on major pairs. This is a crucial safety feature like a governor on an engine, preventing you from going too fast too soon. All regulated brokers will comply with this. What you need to look for is a low minimum deposit. You're just starting out. You don't need to fund an account with $5,000. Find a broker that lets you start with a few $100s once you decide to go live. This lets you get a feel for the market with minimal financial exposure. And finally, customer support and education. This is your control tower. When you're flying in a storm and an alarm you've never seen before starts flashing, you need to be able to radio for help. How is the broker's support? Are they available 24/5 since the Forex market is? Do they have a live chat, a phone number, or just a slow email system? A good broker also invests in their client's success by providing quality educational materials, webinars, and market analysis. So let's put this into action. You've done your research. You've picked a well-regulated U.S. broker with a good reputation. Now we're not wiring them any money. We're not risking a single cent. We are heading straight for the flight simulator. We are opening a demo account. Every reputable broker offers one. The process is simple. You'll go to their website, click on Open a Demo Account, and usually provide just your name and email. In return, they give you a login and password for their trading platform, funded with a big pile of virtual money, maybe $50,000 or $100,000 in paper funds. You'll download their trading platform, let's say it's MT4, install it on your computer, and log in with your demo credentials. The moment it loads, you might feel a rush of intimidation. You'll see charts with flashing lines, columns of numbers, and a dozen buttons you don't recognize. Don't panic. This is your new cockpit and we're just going to learn to press one button today. Look for a window called Market Watch. This is your list of available flights, the currency pairs. Find Euro to US dollar. It's the most traded pair in the world, the New York to London route of the Forex market. Right-click on it and select New Order. A new window pops up. This is your command console. You'll see a few key fields. The first is volume or lot size. This is how much currency you're going to trade. In the professional world, a standard lot is 100,000 units of the base currency. But we're not doing that. We're beginners. We're going to trade a micro lot, which is 0.01. It's the smallest possible position size. Think of it as ordering a single share of a stock versus 100. Always start with micro lots in your demo account. Next, you'll see stop loss and take profit. These are the two most important safety features in your entire cockpit. A stop loss is your predetermined exit point if the trade goes against you. It's your automatic ejection seat. It says, if my position loses this specific amount of money, close the trade immediately to prevent further losses. Take profit is the opposite. It's your destination. It says, if my position gains this specific amount, close the trade and lock in my profits. Using these is not optional. It's the bedrock of responsible risk management. For now, let's leave them blank just to see how a trade works. You'll see two big buttons, Sell by Market and Buy by Market. Your market analysis, which we'll cover in depth later, is what informs this decision. But today we're just learning to press the button. Let's say you think the euro is going to get stronger against the dollar. You would click Buy. Click it. And just like that, you've done it. You have entered your first Forex trade. On your platform, in the terminal window under the Trade tab, you'll see your open position. You'll see the pair, the price you entered, and you'll see your profit or loss ticking up and down in real time. It will likely start as a small negative number because of the spread we talked about. Now just watch it. See how it moves with the chart. To close the trade, you simply click the little X on the far right of your position line. Click it now. Congratulations! You've officially completed your first round-trip flight in the simulator. You took off, you flew for a bit, and you landed safely. You didn't make or lose any real money, but you overcame the biggest hurdle. Inertia. You've now seen the mechanics. You've been inside the cockpit and pulled the levers. Your mission now is to live in this simulator. Place dozens of trades. Buy the euro to US dollar. Sell the pound sterling to Japanese yen. Experiment with setting a stop loss before you enter. Try setting a take profit. Get comfortable with the mechanics until opening, closing, and managing a trade feels as natural as signaling a turn in your car. Because once the mechanics are second nature, you can finally focus on the one thing that truly matters, learning how to navigate. You've successfully flown the simulator, but the real challenge isn't navigating the charts. It's navigating the emotions that come with real money on the line. And that's exactly what we're preparing for in our final, most important part. This is the final boss of trading. It's not a complex algorithm or a secret indicator. The final boss is the person staring back at you in the reflection of your monitor. Your success or failure from this point forward will be determined not by your ability to read a chart, but by your ability to read yourself. Every trader who fails, and most do, doesn't fail because their strategy was flawed. They fail because their psychology crumbled under pressure. When real money enters the equation, two ancient, powerful forces awaken inside you: greed and fear. These are the twin executioners of trading accounts. Let's talk about greed first. In a demo account, you follow your plan. You risk 1% per trade. You take profit at your target. It's easy. Then you go live. You have a few winning trades in a row. That little voice starts whispering in your ear. You've got this. The market is moving your way. Why risk only 1%? You could have made 3 times as much. Let's risk 5% on this next one. It's a sure thing. That's greed talking. It convinces you to abandon the very rules that made you successful. You take a bigger position. The trade goes against you. Now you're down 5%. Panic starts to set in. The voice changes its tune. We have to make that back. Let's double down. We can get it all back on the next trade. This is called revenge trading. You're no longer trading your strategy. You're trading your P&L, trying to claw back a loss. And just like that, a series of small disciplined wins is wiped out by 1 or 2 catastrophic emotional decisions. Your account is gone. Greed convinced you to sprint a marathon, and you collapse before the first mile marker. Then there's its partner, fear. Fear is more subtle but just as deadly. It wears many masks. The most common is the fear of losing. You're in a winning trade. It's moving towards your profit target, just as your analysis predicted. But then it pulls back a little. It's a normal, healthy market fluctuation. But fear screams, it's turning around. You're going to lose everything. Get out now. So you close the trade, taking a tiny profit, terrified of it turning into a loss. 5 minutes later, the market resumes its trend and smashes through your original profit target. You left 80% of the potential profit on the table because you let fear override your plan. The opposite is FOMO, the fear of missing out. You see a currency pair rocketing upward. You didn't get in at the start. You had no setup, no signal from your strategy. But fear whispers, everyone else is making money. You're being left behind. Jump in now before it's too late. So you buy at the very top just as the early smart money is taking their profits. The market reverses and you're left holding a losing position, all because you were scared of missing a party you were never invited to. So how do you fight these monsters? You don't. You can't kill fear or greed. They are part of our human DNA. You can only manage them. You build a fortress of logic and discipline around you, so that when they start screaming you can't hear them. Your fortress is built from 3 critical materials. First, your trading plan. We've talked about this, but now you must see it for what it truly is. A contract with your future self. It is a document written by the calm, rational, analytical you, designed to protect your capital from the emotional, impulsive future you. You must treat it like law. It says you risk 1%. You risk 1%. It says you enter here and exit there. You do it. No exceptions. When you feel the urge to break a rule, you must physically stop, open the document and read it. This simple act engages the logical part of your brain and short-circuits the emotional impulse. Second, your trading journal. This is your therapist, your coach, and your harshest critic, all in one. A journal isn't just for tracking profits and losses. It's for tracking decisions and emotions. For every single trade you write down, why did I enter? What was my logical reason based on my strategy? And then you answer honestly, how did I feel? Was I calm? Anxious? Excited? Desperate? Then you do the same for your exit. Did I exit according to my plan? Or did I exit because of panic? Over weeks and months, this journal will reveal your psychological patterns. You'll see, wow, every time I lose 3 trades in a row, I tend to over-leverage on the 4th one. Recognizing that pattern is the first step to breaking it. You are turning the subjective, emotional chaos of trading into objective, analyzable data about yourself. Third, and most importantly, your risk management. This is your impenetrable shield. The reason fear and greed have so much power is because the stakes feel impossibly high. But if you religiously follow the 1% rule, you defang them. Think about it. If you know with absolute certainty that the most you can possibly lose on any single trade is just 1% of your capital, it becomes psychologically manageable. The terror of ruin is gone. A single loss is no longer a catastrophe. It's just a business expense. It's the cost of gathering information from the market. This frees your mind to focus on executing your strategy perfectly over the long term, rather than obsessing over the outcome of one single trade. With this mental fortress built, you are ready to make the transition from the simulator to the real world. But you do not jump from a flight simulator into the cockpit of a 747. You start with a small 2-seater plane. Do not fund your account with thousands of dollars. Start with an amount of money that is meaningful enough for you to feel the sting of a loss, but small enough that it won't affect your life if you lose it all. For some, that's $500. For others, it's $100. This is your tuition money. Your only goal for the first 3 to 6 months of live trading is not to make a profit. Your goal is to survive and to follow your plan perfectly. You need to prove to yourself that you can execute your system under the pressure of real, albeit small, financial consequences. If you can't follow your rules with $100, you have no business trading with $10,000. This is the point where the get-rich-quick crowd gives up. They blow their first small account, call it a scam, and quit. But this is where real traders are forged. This is the grind. It's showing up every day, doing your analysis, taking your trades according to your plan, journaling your results, and slowly, methodically building the skill of discipline. The journey to becoming a consistently profitable trader is not a sprint. It's a long, arduous marathon. There are no shortcuts. There are no holy grails. There is only the disciplined application of a well-defined strategy, executed with an iron mindset, over a long period of time. You will have losing days. You will have losing weeks. Even professional traders have losing months. The difference is that they understand it's a game of statistics, not predictions. Their job isn't to be right every time. Their job is to make sure that when they are right, they make more than they lose when they are wrong. Losses are not failures. They are feedback. They are the market telling you something about your strategy or, more often, about yourself. A trader who is afraid to lose cannot win. You must embrace losses as an integral and unavoidable part of the process. So as we close this guide, I want you to look beyond the charts, the indicators, and the currency pairs. The skill you are setting out to learn isn't really about finance. It's about self-mastery. It's about learning to control your impulses, to think in probabilities, and to remain disciplined and calm in the face of uncertainty. These are skills that will serve you not just in the markets, but in every aspect of your life. The path ahead is challenging. It demands patience, resilience, and a level of brutal self-honesty that most people are unwilling to face. But the potential reward isn't just financial. It's the profound satisfaction that comes from mastering a complex craft, and more importantly, from mastering yourself. The market is the ultimate mirror, and for those who are brave enough to look, it will show you exactly who you are. Your journey starts now. The most important variable in your entire trading career is you. Master that variable, and you will have accomplished something truly extraordinary.